Hey guys, Rafi here from the Endgame Investor. And today, let's talk a little bit about permanent backwardation and how it poisons the economic system, and a little bit about clogged toilets. How do all these subjects connect? Very simply, actually not so simply, but you'll see what I mean in a minute. We're hearing in the news about shortages this, shortages that, coal, natural gas, oil, shipping, dry goods of all kinds. The question is, what happened in the last 18 months that is causing all these sudden shortages of product? It's not like the global economy has seriously altered. All the stuff that makes all the stuff that we made before all of the lockdowns still there. All the companies that made all the goods and services are basically all intact. Well, not all of them, but the big ones are. And the little ones have been taken over by bigger ones. So it's all still there. So why are there shortages? Well, there is one big difference between pre-lockdown and post-lockdown economy, and that is trillions and trillions and trillions of new dollars and yen and euros and all the other ones. See, in a logical world that made sense, if you shut it down and shut production down, you shut down supply and demand. However, if you print trillions of dollars after locking the world down and try to sustain demand at levels that they were before the lockdowns, then you will have pre-lockdown demand levels with post-lockdown supply levels. And what you will have is essentially a clogged toilet. If the global economy is a toilet, which it seems to be now, and you stuff it full of paper and you try to flush it, it's not going to work. That's the difference. It's not the supply of stuff, it's the supply of money that has changed. And because the structure of production cannot adjust to the new price regime fast enough because they keep printing, the shortages are an inevitable result of that, which is why before any hyperinflationary economy, we always see shortages of various goods and services. And this is what is happening now in the world, all over the place, not in a single country, not in a region, but everywhere. Now, I'd like to show you what is happening numerically. It makes perfect sense. We'll take the example of coal. Here is the coal chart since 2009. You can see very conspicuously that since 2020, here are the lockdowns circling by my little arrow here. Lockdowns bring down demand, and then you print trillions of dollars, and the dollars go down in value, meaning coal goes up in value, and it has not stopped at all. Next slide. This is the current coal term structure. You can see coal for November delivery costs $262 per ton. You go down the chain, and 6 months later, December, January, February, March, April, May 2022 coal costs $190.45 per ton. So what you have here is much more expensive coal in November than you have for May in a 6-month time frame. That's close to a 30% premium for November coal than for April coal. Now, if you are a futures trader or a supplier, a coal producer, or a coal storage company, some company that has a lot of coal to get rid of, to sell, are you going to save it for the future when prices are much lower? Or are you going to sell it now when you can pocket a 30% premium? Obviously, you're going to sell it now. And backwardation like this is supposed to increase supply in the present so that prices go down in the present so that the term structure goes back into balance. It takes two to contango. Isn't that so funny? So in a state of backwardation, you're incentivizing coal storage companies or firms to disgorge their coal to the market and supply it, pocket that premium. If you're involved in arbitrage in this coal market, what you want to do is sell the front futures at 262 and buy the April futures at 140 or whatever it was. That helps you pocket the premium. But who are you going to buy the futures contracts from? Because why would a coal producer want to sell a contract of April coal when they can only pocket 30% less than they can coal now? And what if it doesn't cover their production costs? They'll go out of business. They won't be able to sell the contract. A company that produces coal, generally in a normal term structure, they will sell a futures contract, deliver into a spot contract, deliver coal now, and lock in the prices for the future, and then deliver into that future when it becomes spot. That's how the market is supposed to work. Backwardation is supposed to be temporary until a shortage is alleviated, but it is not happening now. And I will show you an article that I just came across from an obscure newspaper about coal. This is from June 29th, so a little bit a while ago. And you'll see why that's relevant in a second. Title is Steep Backwardation Erodes EU Coal Stockpiling Economics. What is actually happening here? Montel, steep backwardation in the European coal market where prompt contracts trade above those further out, meaning spot prices for coal are more expensive than futures prices for coal. This is deterring traders and utilities from stockpiling coal at ports, with inventory levels down by a quarter on the year. Why would backwardation discourage or deter traders from stockpiling coal? Because they can get more money from it now, and they don't want to be stockpiling it for lower prices in the future. Market participants attributed this reduction in part to unfavorable storage economics, thanks largely to decade-high prompt coal prices, meaning deep backwardation. So what was the backwardation back then? How deep was it? How much more expensive was spot coal than future coal? And let's use that same 6-month time frame that we used in the current term structure of about a 30% premium. The third quarter API2 contract was last seen at around $110 per ton, representing a premium of about $8 over the fourth quarter and US $25 over the 2022 price. So this is June 29th. So we know that June coal prices were $110, which is $8 over the fourth quarter price, which would be December, let's say, and that's about 6 months. So you have a premium of about 8% from spot to 6 months after spot. And look at this next paragraph. The backwardation is unbelievable. You don't want to go long in this market, said a coal strategist with the utility, adding there was no reason to stockpile coal at ports. Of course, there's no reason to stockpile coal at ports when you have an 8% premium not to stockpile it and to supply the market immediately. So 8%, where are we now? We're at 30% premium. So what do you think is happening to coal stockpiles and coal supplies when coal producers can't sell contracts forward because the price is too low and probably doesn't cover a lot of their production costs? Short-term backwardation in markets is normal. It happens when there isn't enough of a good to supply a market, so then all the stockpilers become incentivized to sell the coal now and pocket that spot premium. But when it's a money problem and you've tried to stuff the toilet with so much money that it becomes clogged, then the entire economic machinery gets clogged in the toilet and it can't flush. The entire structure of production freezes, and that is what is happening now. How much more time do we have until the backwardation hits gold and silver and money itself? I don't know, but that's where we're headed. And when we head there, the hyperinflation in prices and consumer prices, which begin at the commodities structure of production, will become obvious to the entire world. Today, coal, today, natural gas, tomorrow, gold and silver, and the dollar is dead. This is Rafi of the Endgame Investor, reminding everyone that it takes two to contango. Yeah, I'm such a genius.